Let's keep it going with the markets. And now the top question doing the rounds in the world this week is, if oil prices are above $120 per barrel and the Iran war isn't over, why are stocks at record high? The answer is simple. The artificial intelligence revolution has simply become so large that investors are viewing everything else as noise at the moment. As large cap technology stocks traded flat, then sharply lower amid the Iran war, the AI narrative has only grown. Wednesday's earnings report from Alphabet, Amazon, Meta and Microsoft confirmed the rhetoric, AI rhetoric that is. Now, Wall Street's so-called Magnificent Seven large tech firms are set to invest over $600 billion in AI this year alone. And as broader market swept tech giants like Nvidia and Alphabet lower, these stocks reached their cheapest valuation level since 2019. At the March 30th low, the S&P 500 Technology Index was trading at just a 4% forward price-to-earnings premium to the benchmark. That is the lowest since January 2019. Forward price-to-earnings ratio is a measure to understand the stock's valuation compared to predicted earnings. The wallet sell-off made tech stocks become cheaper than the average S&P 500 stock for the first time since 2017. Nvidia, for example, is now trading as just a 26 times forward PE multiple, even as it is back at record highs. By comparison, Walmart is at 43 times and Costco at 46 times. The reality is that many large cap technology stocks are merely getting cheaper as they go up. And when they go down, they become remarkably cheap. We are in the biggest technological revolution in modern history. And even $100 oil and rate cuts priced out until 2027 are unable to derail this rally. Many investors had anticipated a much sharper sell-off, and as this did not happen, money has moved back rapidly into the market to chase the rally. While oil prices are set to rise further from the Iran-US stalemate, current market behavior reflects a belief in technological growth overriding geopolitical risks. At least that is the short-term view. While volatility is expected to remain, bets show the path of least resistance for stocks is more to the upside. But the stock rallies test will come from how the Dow Jones Index performs. According to analysis by LSEG, a new bullish trend in the stock market must be confirmed by both the Dow Jones Industrial Average and the Dow Jones Transportation Average to be durable. So far, it's an open question. The Dow Jones Index hasn't made a record closing high since February 10th, before the start of the Iran war. However, the benchmark was tantalizingly close on Tuesday, when it finished just above 2% below its all-time peak. The Dow Jones Transport hit a closing high on April 21st, but the index has slumped since. For the bull market to be confirmed under the Dow theory, the industrials must surpass their February peak soon.